Hey everybody, good to see you all. Viciously, good to see you too on the outside. Normally I see you in the community. Good to see you too on the outside. An interesting one. So sometimes things grab my attention in the morning and they make me a little upset. So today's story is about watching out for fake data. Let me try and explain this story as we jump in. So first of all, it is a bit of a dark story today, and the channel, the community, etc., is all about helping people prepare for what's coming. Now, I don't know exactly what's going on, but there's some weird stuff going on with data, and all we do is look at data, and I can't put my finger on exactly if it's fake data on purpose to manipulate us, or it's complete ignorance, or a combination of both. I don't know, but I'm going to show you a couple of things that, again, leads you to believe maybe it's all intentional to take us down a path, take us down a direction. We're going to look at how many people I expect to be on universal basic income by the end of the year 2030. It's very scary, by the way. How much it costs per child to support for one individual, how many hours they need to work, etc. over a lifetime. It's going to be a story of government data, fake data, the Fed, money printing, manufacturing, European data, disinflation, deflation, dishonesty, etc., and a whole bunch more. And the labor market and jobs and kind of where, macro is crypto, etc. And this is really how we prepare, because weird stuff is going on and it's all unprecedented. So let's go. And before I jump in, a big shout out to Chewy. He joined in May 2022, 1 year into the community, and could not be happier. Best £8.50. I didn't realize taxes are so high in the UK. But we are actively seeking exceptional individuals. We've got a couple of seats open. They sell out in the bull market, and we'll see where it goes. But Chewy is a physician, a medical physician from Europe who works tirelessly, not only on his day job saving lives, but also in the community. And it's not just about me. It's about the collective intelligence of the brilliant minds who are helping everybody gain an advantage in the community for the next 8 to 10 years, which are going to be critical to outperform other market participants. All right, there's never been a more urgent time, and that's why I started this channel. So let's go, and please subscribe if you want to amplify your intelligence. If you're happy with how smart you are, you're fine then. But let's go. Let's talk about the beginning of the data. So Wall Street Journal today, comparing U.S. unemployment rate from the last reading, and we have the new reading tomorrow about job vacancies, etc., which yesterday broke a 3-month trend and went up above 10 million, contrary to the consensus forecast. So here, this little pink line on the openings is kind of up, and that took everybody by surprise. Unemployed is kind of down and flat. So it sounds like, wow, there's lots of jobs. Great. Everybody must be making a ton of money. I'm here to dispel that fact. So first of all, at least, it's probably more like 10 million, but 7.6 million Americans have 2 or more jobs. Some people even have 3 jobs. And the government surveys, etc., count 3 jobs. If one person has 3 jobs, that's 3 jobs. You'd think that's 1 job per person, but no, it's 1 person with 3 jobs. And that's where the big problem comes in. Double counting, triple counting, multiple job holders, etc. It all is a big mess. And then you have the NFP, non-farm payroll surveys, and make a large use of statistical data. And it's often wrong and erroneous. And the question is, why? How? What's going on? Let's go a little bit further. Truth bomb from my former professor at Wharton, Jeremy Siegel, on the jobs report. This is 5 months ago. He shared this in the last video I did 5 months ago on jobs, or 4 months. I can't even remember. Time goes so fast. But he talked about the math of jobs. Household data was minus 150,000 jobs. Hours worked fell to 1/10 of an hour, i.e. 6 minutes, and that equates to losing 200,000 jobs. Fed policies to crush wages, i.e. not pay people as much as they deserve. 7.68 million Americans have 2 jobs a month, etc., etc. All the stuff we covered in that last video, and it got my attention. And now things just got a little bit worse, and it proved that what I said, 20 weeks ago, was all true. In addition, you have the Fed saying wages are the real problem. Fed's Jerome Powell cites top barrier to taming inflation is workers' wages. You guys are getting paid too much all over the world. That's causing the inflation. This is what gets me upset. Okay, so let's talk about the Fed hikes. Because people are getting paid too much. They keep jacking rates, which destroys the banks, destroys manufacturing, destroys jobs, destroys commercial real estate, you name it. Everything getting smashed all across the board because they got to torch those jobs. That way we can bring down the amount people are getting paid. But wait, there's more. Let's talk about the BLS, a government entity. That just proves how clueless they are. The revision on unit labor costs are completely nuts. This changes the entire landscape for the dollar. So if you look at these numbers, the revisions, plus 2%, minus 2.2%, plus 3.3%, etc. It's all over the place. And it's crazy. A better view of that is this. The BLS BS report, okay? Astronomical drops in hourly compensation. Look at this darn report again. Real hourly compensation affirming what the sentiment numbers have been telling us the whole time. We are living in a recession. But look at the real hourly compensation. Down, revised. They said, first of all, it was up a truckload, and then down 4.7%. Business down 4.3%. These are all revisions down in yellow. Down 3.2% in non-financial. Manufacturing down 4.1%. Durable down 5.4%. Non-durable. So the question is, and this is, you always have to try to figure out exactly where the stuff is coming from. How could it all be so wrong? Another view from Frog Capital. Yeah, we told you wages are up 4.9% in the first quarter of 2023, and the Fed was hiking to slow wage growth and everything. It turns out wages actually fell 0.7%. Okay, so we went from, call 4.9% plus 5% to minus 0.7%. That's nearly a 6% swing. So why are they torching jobs when the data is so wrong? We're not talking 0.1% or 0.3%. We're talking nearly 600 basis points. Phew, insane. Now, JP, back again. He has a bone to pick with nominal wage growth. All during 2022, he emphasized wage growth was too high. And in November, nominal wages have been growing at a pace well above the fake 2% inflation, which we haven't had, again, in the last 30 to 40 years. Never below 5% inflation until now, because things are crushed down so much. We'll talk more about that in a minute. Let's go to manufacturing as well. Manufacturing is in the pooper. Now, if you ask the Fed, etc., they say the economy is strong, etc., and you know how the Fed always overshoots to the upside and to the downside. Well, the Fed completely overshot, and these people are clearly morons. Again, if you look at all of these numbers, the trend is down, and it's down aggressively for all things manufacturing. Pick any number on that sheet. It paints an ugly, ugly picture. Manufacturing is in the pooper. People are now getting surprised by PMI numbers going, what happened? Well, it's pretty clear. In addition, no new orders. The economy is dying, and the Fed says everything is fine. This is the US ISM PMI. New orders minus customer inventories fell to a new low, down 8.8% over the last 2 years, indicating weak demand and continued heavy inventory pressure from manufacturers. No worries. Just keep jacking those rates. Everything's going to be fine. Keep burning this thing. Confirmation of death of the economy. All good. Keep hiking. The collapse in the ISM manufacturing supplier deliveries continues, okay? This is now at the same level of the global financial crisis at the very beginning of 2009, okay? That's when kind of lights out. Nothing was happening in the economy. And here we are back again. So the question is, what's going on? Germany. Let's go look at Europe for a second, because there's similar stuff happening over there. German retail sales is following Sweden. Again, consumers have gone on a buyer's strike due to high inflation and negative real wages. Price-adjusted retail sales slumped 8.6% in April. That's not a small move. That's nearly 10%. And a drop in food purchases of over 10%. People aren't buying food anymore in Germany. It is that bad. Okay, this is just tanking. I put a report out on Sweden a few weeks ago. I can't remember. But it was the same type of thing. The biggest drop ever retail spending in history in Sweden. Now Germany. Germany is the industrial engine of Europe. Insane. So speaking of Sweden, this is from Steno Larsen. Big thank you to Sanjay for sharing. This is basically no doubt left that Sweden is entering a pretty serious recession. And the PMI is at 40.6 this morning, just like the US. Third weakest level ever in history for Sweden. Everything all over the place is grinding to a halt. What's going on? But there's lots of jobs. I don't get it. Okay, everything's grinding to a halt, but unemployment is extremely low. So if you look at this European numbers, youth unemployment rate 13.9, the lowest ever on record, and unemployment rate across Europe 6.5%. So when the government officials look at these numbers, they say everything is fine, no problem. But maybe the Europeans are miscalculating the unemployment numbers as well. Who knows? Let's look at deflation in Germany. Crazy deflation. Germany's inflation-adjusted retail sales obviously tanked a whole bunch, but this shows you exactly how much prices are falling. This is retail sales excluding motor vehicles. And motor vehicles, if you add them on, it's even worse. Part of what's actually killed the German economy is the fact that they're no longer selling cars in Asia because they're all buying EVs. I won't talk about that. Now, this shows you exactly how incredible things are. So the US government thinks we are now at 5%, 4.9% inflation. Trueflation says 2.96%. And if you look at shadow stats, they say it's north of 5% as well. The question is, what exactly is going on with the true inflation number? Obviously, it's coming down. It's disinflationary. And soon it could be completely deflationary, which is a big problem for the government as well, because that means their debt actually grows. They don't shrink it away through inflation. And they don't want that to happen, trust me. Now, let's look at taxes as well. Another problem for the government. Taxes are down in the US 10%. Okay, that is a lot less than last year. And expenses are up. And the deficit is going to be north of $2 trillion. That's why they had to print $4 trillion. We'll talk more about that in a minute. Now, let's talk about what's going on with money printing, because this also is so key to why we need to be in hard assets and protect ourselves and where everything is going. We have a perfect storm of things happening all at the same time. Deficits exploding, so-called inflation, deflation, disinflation, whatever you want to call it, all over the place. Labor numbers confusing the hell out of us. People earning a lot less in real terms. And it's crazy. But let's look at the RRP. And for those who don't know, this is a facility tool that enables banks to lend their excess reserves to the Federal Reserve. In exchange for these loans, the Fed pays them interest, sometimes just for a night. And the RRP is designed to help the Fed manage the supply of reserves in the financial system. What's key about this is the RRP, which is Reserves Reverse Repo Facility, has 1.7 trillion in it, but it's not enough to finance the upcoming supply of coupon treasuries, because they're going to try raise at least $500 million to $1 trillion in a very short window of time. The problem is there isn't enough depth to absorb that out there. And a lot of people are concerned there'll be a big sucking on the actual money supply in the economy too. Let's look at another view of it. This is the reserves to contract more than the RRP that we just discussed. So the Treasury wants to increase their TGA account, which is Treasury General Account, by $500 billion over the next 4 weeks. 4 weeks. Completely unrealistic, but they might do it. But again, everything's kind of broken and they might break it some more. Even a gradual increase in the TGA to, say, 600 billion by the end of Q3, take us to September, would likely lower reserve levels to be inconsistent with the Fed Reserve's abundant reserve operating framework. And this suggests that the Fed will end QT before the end of Q3. So this is why the market's rallying so hard today. Risk on, tech names are going through the roof like crazy. Meta, Tesla, you name it, are going bonkers. Nvidia's back up at nearly $400. But this is because the QT that they tried to enforce for a long time is going away. They did reduce the actual money supply by about 4% so far year to date, but that's about to go to QE again. Let me explain why. So here, this was a concern as well, because the TGA needs to raise money because they have so little. They actually were out of cash, or supposed to be out of cash in 3 or 4 days. And that's why the race is on to sell maybe $500 billion, maybe $750 billion of treasuries. And over the next 3 to 4 months, maybe $1 trillion. We're not sure. But this could lead to a tightening of liquidity in the financial system. But some analysts believe that the impact will be minimal. So for those of you who are concerned that this could tank the stock markets, I don't think so. We're definitely not seeing that right now. And Treasury cash reserves, again, are down to zero. So they need to jack them up as quickly as possible. So for those of you who are worried about this killing the stock market that many people say it's going to, the Financial Times does not believe that's the case. So you can relax like the frog there in the grass. In addition, Balaji talks about $4 trillion coming. And the interesting thing here is he says if the debt ceiling is raised and the Treasury can borrow again, they'd be borrowing a lot. We're talking $500 billion to $1 trillion in 4 weeks. It's bonkers numbers. But who has that kind of dollars? Not the banks. They died buying bonds. Not the foreigners. They don't trust the dollar and they're buying gold. And especially all the BRICS countries as well. And it's the Fed with what they call yield curve control. And this is the government monetary policy used by central banks to influence the shape of the yield curve, i.e. the relationship between interest rates on short and long-term debt. And the Fed does it by committing to buying a certain amount of long-term treasuries or other debt securities like MBS, mortgage-backed securities, and keep those to stimulate the economy growth by making it cheaper as well for businesses to borrow. So this is why the markets are excited, because QE is coming back. We always say QE to infinity. There might be small little periods of time where there's none of that, but that's not the case right now, especially with this new debt ceiling excitement. $4 trillion more in the kitty. Now, there are some people that are very upset about this $4 trillion insult, and this is part of this whole story today. So a guy called Rosendale called the proposal Fiscal Irresponsibility Act, the FIA, because it would increase the debt ceiling by $4 trillion and actually in 2025 beyond that. And again, the proposals failed to cut spending, increases to fund crazy agendas, etc. And it's an insult to the American people because they are the ones who are going to have to foot the bill for this. This is the whole thing. They're putting it on the credit card and you will have to pay for that credit card. The same thing is happening as well all over the world. Not just the USA. Now, in terms of people earning less and less, this is another case in point from today. Yesterday, there was a 6.8% rise in the number of people earning less than the living wage on the Isle of Man in 2022. A survey has found. Shout out to Simon Dixon, who lives in the same place, by the way. So again, scary times as well, scary numbers. People are earning less and less, and this is where we're going with this story. There's a method to the madness. So let me catch you up so far on what we've discussed. So first, on the left, the government view, workers are earning too much. The economy is strong. Banks are fine. The Fed feel the need to smash the labor market to control inflation. The real view is workers are earning a lot less. Real wages are falling. The government publishes incorrect data. Nobody reads revised data like 6 weeks, 8 weeks, 12 weeks later. So it just, the media never mentions it, etc. So that's why we make these videos. Productivity is dead. Manufacturing is dead. And kill the patient to cure the disease. And the inflation is lower than the government realizes. So, got the left view and the right view. Who knows what's right? I'm betting on the red stuff there. So, quick summary. There are 3 kinds of lies. The lies, damned lies, and statistics. From Benjamin Disraeli. And this has never been truer. And the fabrication of data, again, I don't know if it's pure ignorance or it's intentional. But let's get into some more data around jobs and where things are going in Europe, in Australia, in South America, in North America. I'm just using American data here because it's the one I know best. So the average wage in leisure and hospitality in the United States is $24.29. If you look up that the average wage for all other jobs is $31.73 an hour. So the only place where jobs are growing is leisure and hospitality. And they also have the lowest wages. So we're not adding high value add jobs. And of course, you've heard me harp on about the fact that AI is going to hurt a lot more jobs, especially we may actually see them happening already in professional services. For example, consulting firms. I know consulting firms, they're laying people off because they're having people work more effectively and efficiently using AI. Information technology, education, health services. Education, I covered a couple of cases where they're getting smashed too by AI. Financial activities, manufacturing, the bots are coming, all that stuff. This is going to get worse and worse over time. The jobs are already decreasing in the core areas. The only people The only jobs that are being created are these hospitality and leisure jobs, and they are the worst paying of all, unfortunately. So let's talk about one of the direction where I'm going towards UBI. And here, last time I shared something like this, people were stunned about how much it costs to raise a child in the United States. But today it is $233,610, according to a 2022 report by the USDA. You can look it up on Google. And the report found that the cost of raising a child, of course, varies depending on a number of factors, the age, the location, family income, etc. But on average, it's $250,000. And of course, it gets more expensive 4 to 12 years, and then it gets a little bit cheaper 13 to 17 years. As cheapest as a baby, birth to 3 years. I found that interesting. But the average wage, if you take a hospitality job to fund the living of a child, the average wage is $24. You've got to pay $233,000 over 18 years. That means you've got to work 9,617 hours, and that is the hours worked per year on average is 2,080. So you got to work exactly 4.623 years of your life just to pay for this one child. And of course, if you get taxed on that, you got to work a lot more hours. So that's assuming tax-free. So just to put things in perspective, the reason I mention this is because right now, today in the United States, 21.3% of the US population is dependent on the government for assistance, to pay for food, to pay for you name it. And that is approximately 70 million people. That's big. Now, I do believe over the next 8 to 10 years, AI, bots, automation, etc. will take away at least 25% of the existing jobs, probably a lot more. So what does that mean for the world going forward? Well, I estimate that 44% of the people in the United States will be dependent on universal basic income because 25% of jobs will be taken over the next few years. This is why I've been so concerned about this. I'm talking about it for probably the last 6 to 8 months. So the population in the US today is 332. For this number, I assume it grows to 350 million people. Workers today, 161 million people. 25% of those 161 million jobs will be gone. Call that 40 million jobs. And the average worker supports themselves and another 1.06 people. So call that 2.06 people. If we do lose 25% of jobs due to AI, that means workers lost with support will be 83 million people on top of the existing 70 million people on universal basic income. That means total dependence in 2030 will be 153 million people, or 44% of the US population. And I think the government knows this. They know it's coming. And people, again, they can't, even on a hospitality job, you can't afford to support a child. You just can't. And I proved that with numbers as well. So enter UBI. This is the government program which every adult citizen receives a set amount of money regularly. No ifs, ands, or buts. I think we're going in that direction fast, which scares me because half will be dependent. And the conclusion of this whole video, really getting down to it, UBI is the answer. And that's why they're coming out with that thing called FedNow. And that is a real-time gross settlement service that is scheduled to launch, I think, next month, July 2023. And it'll allow faster and more efficient payments to those people on the universal basic income, and of course control what they spend on, etc., etc. That's why they're putting it in place. There's no other way the government can make it out without this program. In addition, inflation is theft, as we've discussed many times. It's a monetary phenomenon. It's not caused by increase in wages. Everybody, it's caused by increase in the money supply. And they've just increased the money supply by another 4 trillion. Ugh. And a lot of people that don't watch this channel don't see what's coming. And this is why I'm raising the kind of like alarm bell flag thing here. Also, inflation is theft because it erodes the value of money and savings. And inflation is a major cost to the economy because it leads to uncertainty, misallocation of resources. In fact, for every $4 the government spends, they create $1 in value. So they lose $3 along the way because they don't know how to allocate money. Big problem. In addition, there are a number of policy options for reducing inflation, including ending government's discretionary power over the production of money and returning to something like a gold standard or a Bitcoin standard, and of course ending fractional reserve banking, which has just been exposed as well to many who never even knew what it was up until a few months ago. And inflation is a serious problem. It needs to be addressed. Money printing is going to continue forever because we're in this death spiral. And there's only one way out that I see, the escape. And a shout out to Jeff Booth, who's been shouting this in the rooftops for a long time. But technology leads to deflation. But it'll also, this is where him and I differ, it won't lead to a lot of abundance. It'll lead to a lot less jobs. And that is my concern. That's how him and I kind of differ a little bit. The current system is manipulated by central banks and governments, and it's not an accurate measure of the economy. I proved that with data. UBI will become more pervasive, and the only way is to get a hard asset or multiple hard assets and something to help weather the storm that's coming. Because the money printing will continue, there will be more UBI, which means those people that are paying taxes will be taxed more to support those that aren't. And the future is a little bit scary. So with that, everybody, I don't want to share this type of news. It doesn't make me feel good, but you guys need to know it. So thanks for being here, everybody. Let me try shut this down. Thank you, everybody in the chat too. Sorry for being a little bit animated, but these are serious times and very, very serious issues. So hit the like on the way out. And I'll see you all tomorrow with some better news. Talking about good sides of technology, good investments to be made, and where things are going and what our plan is for the summer months as well. Thank you all. Bye.